The future of Indian equities, a quantitative approach to investing. Today, we're breaking down one of the most important trends in global investing, how India's equity markets are becoming a long-term growth engine and why a quantitative approach is the smartest way to capture that opportunity. We're not looking at hype, we're looking at data, metrics, and reputable signals that help investors build wealth with clarity. Why India is positioned for long-term growth is simple. India's economy has been expanding at one of the highest rates globally. Three major factors are creating this long runway: demographics, digital transformation, manufacturing expansion. From a quantitative viewpoint, these translate into rising earnings, strong corporate profitability, long-term consumption growth, expanding market capitalization. These aren't opinions, they're measurable economic signals. What the quantitative models show: strategy doesn't rely on emotions or predictions. It relies on reputable indicators such as earnings, sector strength, trends, price to earnings ranges, liquidity, and how volatile the patterns are. When you apply these factors to India's market, a consistent theme appears: upward momentum, manageable volatility, especially compared to other emerging markets. Quant models show India's strongest performance in sectors like information technology, financial services, energy, infrastructure, and consumer goods. These categories have been delivering positive long-term signals for several years now. Where the growth is coming from: financial services, banking, digital payments, and fintech, technology, software services, cloud adoption, and AI-based companies are gaining ground. Infrastructure build-outs, transport, logistics, and energy projects are creating long-term revenue pipelines. The consumer expansion: a growing middle class increases spending on retail, real estate, and lifestyle sectors. Each of these categories show strong earnings, consistent price strength, two core quantitative indicators. How investors approach India is simple: a data-driven strategy focused on screening for earning consistency, tracking valuation bands, observing trend persistence, sector rotation analysis. Instead of reacting to news or short-term movements, a quantitative investor relies on measurable market behavior. There's always risks. All markets come with that, including India. But quant investing helps reduce uncertainty by filtering out overvalued companies, avoiding sectors with declining earnings, tracking volatility to size positions appropriately, using data, not emotions, to decide entry and exit points. This creates a structured strategy instead of guesswork. Why Indian equities are long-term opportunities? Combining India's economic expansion with a quantitative framework gives investors exposure to one of the world's fastest growing markets, a data-driven playbook for long-term wealth, a stable approach that performs well across cycles. This is a market with strong fundamentals, measurable momentum, and long-term global demand. The future of Indian equities isn't just a trend, it's a strategic shift supported by the data. If you want growth, diversification, and a structured investment plan, a quantitative approach gives you clarity and consistency.